Good morning, and welcome to the Energy Perspectives Group webinar hosted by Source Rock Royalties. This event is being recorded. During the presentation, all participants will be muted. If you have any questions you would like to ask, please type them into the chat feature. We will read and answer questions at the end of the presentation. Thank you so much for joining us today. Now here is Dan Steffens, who will introduce today's speaker.
Okay, everybody. I know some of you are just logging on right now, but we had a little trouble sizing the screen, but when we go to the next slide, it's going to get fixed. But anyway, welcome to today's webinar. It's being hosted by Source Rock Royalties, which trades on the TSX Venture Exchange with the symbol SRR. Brad Doherty will be making the presentation today. Brad is the company's founder, chairman, president, and CEO. And all I know is when people have 4 titles, they must be really smart. So anyway, Source Rock is a pure play oil and gas royalty company. It was formed in 2013. All of Source Rock's royalty interests are located within the Western Canadian Sedimentary Basin, WCSB. Source Rock's existing royalties are predominantly light oil focused, and Source Rock continues to target royalty acquisitions in oil producing assets. Source Rock is focused on the acquisition of already existing royalties as well as creating new royalties carved out of working interest of exploration companies. Most of the company's assets are what we call overriding royalty interest, or ORRI, in the United States. Source Rock's strategy is premised on being a sustainable and scalable business, and Source Rock thrives to execute on balanced growth and yield business model. While top-line royalty revenues and royalty production growth are important to the long-term success of Source Rock's business, management views a strong operating netback per barrel as the key metric for the success and sustainability of the business. The company's low-cost structure, like all of the royalty companies, provides insulation from inflationary pressures and positions the business to maximize bottom-line growth when royalty production and revenues increase via new drilling, accretive acquisitions, or higher commodity prices. Maintaining low costs also provides insulation from decreases in production volumes or commodity prices. And Source Rock further protects itself from the industry's volatility by having a strong balance sheet and no debt. The company's current dividend should be covered by operating cash flow as long as the oil price stays over $60 Canadian. That's $60 in Canadian dollars per barrel, which we're way above that now. Except for 2 quarters during the COVID pandemic, Source Rock was able to pay dividends to shareholders in every quarter since the first quarter of 2014. It now pays monthly dividends, which I like, of 0.0065 cents Canadian per share, or 7.8 cents per share, for annualized yield of 8.86% based on this morning's share price. So Source Rock's management and the board of directors have decades of experience in the Canadian oil and gas industry and the capital markets. They own approximately 9.5% of Source Rock's common stock on a non-diluted basis. So they're aligned with the goals of shareholders. And approximately 5% of Source Rock's common shares are owned by the founder, president, and chief executive officer, which is Brad, who's presenting today. So during the webinar, if you have any questions, please type them into the chat box and we will answer them after the presentation. With that, I will now turn it over to Brad Doherty for an update on Source Rock Royalties' success in 2023 and their business strategy for 2024. So go ahead, Brad.
Thanks so much for having me, Dan.
Okay.
Great intro. I'll retouch on a lot of those things, but really to reiterate, Source Rock is a pure play oil and gas royalty company, and again, we are exclusively focused on Western Canada with respect to where we acquire our royalty interests. Ticker SRR on the TSX Venture. The primary reasoning for our mandate as a royalty company is that owning royalties only allows us to have no ongoing capital costs associated with the royalty lands. We have no future liabilities associated with the royalty lands, and royalty interest combined with our focus on oil really allows us to drive this high netback or profit per barrel in our business. So we are the only pure play oil and gas royalty company listed in the public markets in Canada. We have 3 much larger peers that are 2, 4, and 6 billion market cap companies. And we're sitting here today as a 40 million market cap company, about 37 million enterprise value net of our cash, but with an 11 plus year track record of building out this business model. So despite that long history, we still have a very clean capital structure with only 45 million shares outstanding, no warrants or anything outstanding. At this point, we just have some incentive securities to management and board. So a fully diluted share count of just under 49 million shares. As Dan mentioned, good alignment here from an insider perspective. I own 5% of the company, just over that, as the founder on a non-diluted basis. With the other management and board, we own about 9.5%. Then we have a large institutional shareholder, CN Rail Pension Fund, who owns 21% of the company. Now, it's important to note that there are no cheap shares issued in this company. So I went straight in with everybody on day one with hard dollars as the founder of the company. I wrote a hard dollar check in every financing we've done in the history of the company, and my average cost is right around the current trading price. I've actively been buying stock in the market since we went public, whenever we're not on blackout, and so very aligned, from call it a cost of our shares standpoint, and that goes across the insider group. So CN as well, they have an average cost of shares of around 90 cents. Their first participation in Source Rock was mid 2014, and they again participated in every financing we did from that point forward. Also buying stock as a private company in the gray market before we were listed. So very aligned and supportive. We all have an average cost of our shares right around the current trading price. And then from a balance sheet standpoint, as Dan mentioned, we have no debt in the company, and we have never used debt in the company. So we maintain a cash balance at all times so that we can be acquiring new, smaller royalty interests. Currently, that's about a $3 million working capital position, which is about 6.5 cents per share. And then we have that monthly dividend that Dan referenced, which is about 0.0065 cents per month, or 7.8 cents per year, for just under a 9% yield on our current trading price. So very strong alignment, a very clean balance sheet. We want to control our own fate in the business. And then again, importantly, on the insider ownership standpoint, I like to point out that no insider has sold a share since we went public in March of 2022. So very strong, again, support from the insider group, very aligned on the long-term growth and success of this business. So quickly here for a snapshot on our most recent results. We put out Q1 results last week. So Q1 2024 was a record production quarter for us. We had just about 240 BOE per day of production, 95% oil. That's predominantly light oil. We do have a portion of our portfolio that is heavy oil now, which I'll get into more in some subsequent slides. That gave us 1.7 million of revenue. So good revenue quarter. Ultimately, oil was quite low in January, February, and we saw that trending higher throughout the quarter, with March being the strongest month in the quarter. That then netted us with 1.3 million of funds from operations, which for our business is free cash flow. So that's net of everything. That's net of tax. That's net of G&A. That's net of all aspects of the corporate cost structure. That drove a net back for us of $60, just over $60, which again is net of everything. So our net profit per barrel of production was over $60. From our standpoint, that's a top tier, borderline industry leading metric that we're driving with that oil focus and our low cost royalty structure. Our dividend payout ratio for Q1 was right around the 60% level. We typically try to maintain a 50 to 70% payout ratio on an annualized basis. For 2023, that was around 53%, trended a bit higher here in Q1 with oil prices being a bit lower. So then quickly on our actual business model. So again, royalties as a pure play business strategy is quite a strategic approach to owning oil and gas interests. So we have no ongoing cost to drill wells or optimize the lands in which we own royalty interests. All of our royalties are what's called interests in land, where again, we either have a royalty that's carved out of the working interest in those lands, or in some instances, we own the actual mineral interests and there's an operator drilling those lands on our behalf. But the important dynamic is that we, again, do not drill wells ourselves. We do not have any ongoing cost to drill wells. We have no ongoing cost to optimize the production on the lands. And longer term, we have no exposure to abandonment, reclamation, or environmental costs associated with those lands. So again, very clean from a capital cost structure standpoint, where we buy our royalty interests. That's our entire exposure to that asset. And then we benefit from the development that happens by the operator. Importantly, as well as I referenced with respect to our netback, we benefit from strong oil prices. So we benefit from top line revenue where we have little or no exposure to the deductions associated with producing from our royalty lands. So when an operator sells our oil at $90 Canadian in the field, we receive that $90 Canadian. We don't then have deductions associated with transporting, producing, processing. And so our receipt of oil price is higher than an operator because again, we're not exposed to the different cost structure and layers to selling that oil. As mentioned, day to day, minimal management costs in this business. So I am the only full-time employee of this business after 11 plus years. So we do maintain a very lean structure in terms of how we run the business day to day, really trying to drive free cash flow for shareholders. And ultimately that positions us where we have really no inflationary pressures on the business. So we've had virtually a static cost structure in our business for the last 2 years, despite having strong growth in the business. And we really strive to build our business in a way that allows us to keep this simple cost structure so that we can make sure top line growth translates into bottom line growth. So in terms of our team, again, I'm the only full-time employee day to day. My background is as a corporate finance lawyer. Ultimately, I started Source Rock, as I was practicing still at the end, and really saw it as an opportunity to build out an oil and gas company that fit my skill set and fit my relationship in the industry. So as time's gone on, I positioned myself around a key group of people that help facilitate this I'll call it simple, low cost platform that we run the business from. And so our CFO, Shireen Lowe, lots of in-depth industry experience, starting off as an accounting professional, transitioning into the capital markets as a research associate, and then having various positions as CFO in the upstream oil and gas industry. So very great resource for us day to day. She facilitates the financial reporting for the business and the record keeping of all of our royalty interests. And she is, again, really kind of, not quite full time, but there as much as we need her. And to facilitate, again, the financial record keeping and reporting side of the business. Day to day, I am facilitating, the growth ambitions and public company marketing aspects of our business, and really kind of focused on positioning acquisitions, structuring them, negotiating them, and finding those transactions. Important for our business strategy is that we do not look to compete against anyone else in pursuit of our acquisitions. We are typically looking to find these acquisition opportunities on our own through our niche relationships, and then looking to negotiate directly with counterparties. And again, to avoid, kind of competitive processes for our acquisition opportunities. In order to execute on that strategy, we leverage not only my relationships, but our independent directors' relationships in the industry. So we have a very tenured, invested group of directors. We have 2 geologists, an engineer, 2 landmen, and 2 accounting professionals on our board. Again, a group with very niche relationships on the ground in Western Canada in the oil and gas industry. So June Marie joined us in 2023. A very great background in the accounting side of the oil and gas industry, most recently with Tamarack Valley, prior to recently joining Thread Innovations as their CFO. And then aside from June Marie, we have a lot of tenure on our board. So John Bell, Gary McMurran, and Scott Rideout have all been involved in Source Rock as a director since inception, so 11 plus year tenure. And then we had Jordan Keevil joined our board in 2014. Sean Thiessen joined our board in 2015. Sean was actually the lead landman on the spin out of Prairie Sky Royalty from Encana back in 2014. Shortly after that, he left Prairie Sky and then joined a private equity backed E&P company, and then joined Source Rock's board. And then Dean Potter joined our board in 2017. Dean is a 45-year geologist. He's actually in the Oil and Gas Hall of Fame in Saskatchewan for all of the discoveries that he's made. He provides us with a very in-depth technical lens on our acquisitions. And so, again, not only do we leverage our group's industry relationships, we're also able to leverage our group's technical expertise, in particular, Dean on the geology side, and then Gary McMurran is a very engaged reservoir engineer, looking at opportunities for us as we bring these in. So again, importantly, very vested group, long tenure, strong relationships that are niche in the industry, really help drive our deal flow, and then ultimately, again, we can use our group's technical expertise to help evaluate transactions. So in terms of our history, as Dan mentioned, we've been around since 2013. From 2013 to 2021, we completed, numerous royalty acquisitions and financings to kind of build the initial platform of producing royalties for the business. We were finding though that ultimately positioning capital alongside acquisitions as a private company was a bit of an inefficient process that was resulting in us losing out on certain opportunities that we wanted to complete. So in 2022, we took the step of listing on the TSX Venture Exchange. We raised just under 13 million of net proceeds, really to position us to ramp up our acquisition strategy with a pipeline of deals that we had in front of us. In early 2022, we ultimately saw oil take off, obviously, as we all remember, to what ended up being almost all-time high Canadian dollar oil prices. And so we found ourselves just completing our IPO, cashed up, but then in a very different oil price environment. And so we did kind of pause our acquisition strategy and then position the business to be an acquirer in a better oil price environment, which I'll jump into in the next slide. So ultimately, though, rolling into 2023, we did roll out our acquisition strategy. We continued with our dividend strategy, actually increasing our dividend along the way. And then again, we completed a series of acquisitions, which I'll jump into here more in the next slide. But ultimately, on our history, again, we have $43 million of royalty acquisitions completed since 2013. We have an 11-year track record, 11-plus-year track record now of being cash flow positive. So we have never had a quarter in the history of the company that wasn't cash flow positive. That includes Q2 of 2020 when oil went to zero. And at that point in time, we were seeing shut-ins across our royalty lands because oil was so low, but we still managed to be a cash flow positive company for that quarter. Again, long track record of paying dividends starting back in 2014 and still paying dividends presently, which I'll get into again in a subsequent slide. So just to kind of map out what we've done since we went public. So as I mentioned, we went public in March of 2022, cashed up kind of right as oil prices took off. And so, we found ourselves with a pipeline of deals that we had positioned, in a kind of high 60s, low 70s oil price environment. And ultimately, those deals looked a lot different for us as soon as oil was in the 90s and going to the hundreds. So, we hunkered down and did not deploy our capital aggressively for Q2 and Q3 of 2022, right after going public. At the same time, though, we were seeing our existing royalties hit record production and record revenue on the back of strong oil prices, and those strong oil prices driving strong drilling activity on our existing portfolio. So, ultimately, we waited out the oil price environment in 2022, didn't spend any of our cash in Q2 and Q3 of 2022, and then started an acquisition strategy in Q4 of 2022. So you can see here from Q4 2022 to Q2 2023, we completed 3 transactions. These were all created royalties where we worked with an operator to carve out a royalty from their working interest. And then we ultimately pushed into 2023 and completed a transformational transaction in December of 2023, an $8 million transaction, which is our first heavy oil exposure in the business. So adding all that up, we completed $16.5 million of transactions from November of 2022 to December of 2023. And again, in an oil price environment that was much more suited to our acquisition strategy. Along the way, we were able to increase our dividend in 2023 2 times, actually. We increased our dividend in April of 2023 and then again in October for a 20% increase in 2023. And again, we were still maintaining a strong cash balance as we were completing these acquisitions and paying these dividends. So since our public listing, we have increased production by greater than 40%. We've increased our royalty lands by 100%. And importantly for our strategy, we're again not only increasing our proved producing reserve profile, but we're increasing our exposure materially to undeveloped land that has ongoing drilling exposure for growth in the portfolio. So quickly on our dividend strategy alongside our acquisition strategy is that, we are ultimately always trying to maintain a balanced growth and yield approach to this business. And so, as I mentioned, we had a record production quarter in Q1 of 2024. We had a record annual production level in 2023 of 208 BOE per day. But again, that's alongside this dividend strategy that has been very consistent over 10 plus years now, and then ultimately has been a growing dividend strategy for the last couple of years. So you can see here what we're showing is the choppy WTI chart in the background here over 2014 to 2023. You know, oil's been bouncing all over the place, multiple material sell-offs. But you can see the consistency in our dividend here is that we paid a 1.5 cents per share quarterly dividend, or 6 cents per year, for 25 consecutive quarters from Q4 2014 until Q2 of 2020. As Dan mentioned, when COVID broke out, we paused the dividend for Q2 and Q3 of 2020, but then we quickly reinstated it in Q4 of 2020, and then paid again that quarterly dividend for all of 2021, all of 2022. We paid the 1.5 cent per share quarterly dividend in Q1 of 2023, and then we transitioned to a monthly dividend in April of 2023. When we transitioned to a monthly dividend, we increased the dividend by 10% at that point in time. And then, as I mentioned, we increased the dividend by 9% in October of 2023. And then most recently in April of 2024, we increased the dividend by another 8%. And so that gives us a 30% total increase to our dividend effectively in the last, since March 2023. And so that's kind of an increase every 6 months. So April, October, and then April again. And so, you know, again, we're seeing dividend growth along the same at the same time as seeing production growth. This is a core component of our business model, paying this yield, but again, not at the expense of growth in our portfolio. So we have now paid more than 17 million in dividends back since 2014. Again, doing so alongside production growth and, importantly, diversification and build out of our royalty lands. And then doing so at a payout ratio that, again, has been kind of around that 60% level for the last extended period here. So dividend sustainability is obviously a very key topic. And so, you know, again, we're always trying to grow the dividend in lockstep with our asset growth, but ensuring that, you know, there's still downside protection to that dividend if market conditions roll over. And, you know, market conditions are not only oil prices. Obviously, oil prices would influence production on our assets. So, you know, so what we're showing here is that we're showing a production rollover in our portfolio. As I mentioned, we were 240 BOE per day in Q1. So if we show a longer term 200 BOE per day production profile for the business, our annual dividend of 7.8 cents per share, you can see here that our dividend would hit 100% payout ratio at about $60 Canadian per BOE. So lots of downside protection here. You know, currently we're slightly above this $80 Canadian level, even with oil prices pulling back here recently. So, you know, great strong free cash flow profile on the business at $80 Canadian. But again, still some protection to the downside here. And again, we would hit 100% payout ratio at $60 Canadian, assuming 200 BOE per day of production. So in terms of our asset portfolio, so, you know, we've completed, you know, again, numerous transactions, upwards of 40 plus transactions over the history of the company, building out what I like to call a diversified portfolio over Alberta and Saskatchewan. And so we have 150,000 gross acres of royalty lands spread out amongst the two provinces. That is currently providing us with, again, you know, we like to say long-term assumptions of around 220 plus BOE per day. Q1 at 240 is obviously reflecting some strong drilling activity in the portfolio. And then, you know, we ultimately have, though, again, diversification across various plays. And you can see that here in the sense that we've got Southeast Saskatchewan down here in the far right-hand corner, segueing into West Central Saskatchewan and East Central Alberta. And then, you know, again, good plots of land here in West Central Alberta, spread out, giving us exposure to various plays, all oil-focused plays. You know, that, again, exposure is not only light oil now because we have completed one heavy oil transaction. The heavy oil transaction was a Clearwater transaction here at Figure Lake. That gave us exposure to 95 sections of land with strong existing production and ongoing growth. So again, diversification in the portfolio from a land perspective with 150,000 gross acres. We have diversification from a wellbore exposure standpoint as well. There's nearly 1,000 wells contributing to our royalty production across this portfolio. That includes, you know, about 7 unitized properties where there's a lot of wells pooled together to then create, a smaller net interest for all of those owners, but in a larger pool of unitized wells. So it really does, again, diversify and kind of de-risk the production portfolio from the standpoint of not having too much exposure to any one wellbore or group of wellbores. And so again, that helps with the decline on the portfolio, and then the breadth of land helps with the upside exposure in the portfolio. We also have good diversification of our royalty payors. So we have 99% of our revenue paid by this list of companies here. There's several recognizable larger Canadian public companies on this list, being Whitecap, Crescent Point, obviously newly named recently, Surge Energy, Vermilion. One of our smaller public company partners is Rubellite Energy. They're a 300 million market cap type public company. So again, a very strong, well-positioned group of payors. We do have some private company partners in here as well, and payors. Axium Oil and Gas and Innova Resources are two of our larger payors. They are smaller private companies, very well-run groups. So 2,000 plus barrel a day companies with no debt, strong cash flow profiles, very tightly owned businesses that are run extremely well. So again, very, very strong payor group, really no issues, day to day, month to month, collecting our royalty revenue. And again, a group of payors that are actively, drilling the plays and the lands that we have exposure to, with the focus of that drilling being our Clearwater lands and our Southeast Saskatchewan lands. So the Southeast Saskatchewan portfolio is important to emphasize here a bit, in that, we have been seeing approximately one well per month drilled on our lands now for over 2 years. And that drilling activity is somewhat focused on Innova Resources being one of our partners that we've done various transactions with. But we are also seeing that really spread across various operators. So in Q1, we had 10 wells drilled on our lands, all Frobisher wells, which is a shallow light oil formation that doesn't require any fracking. It's conventional open oil production. And so those Frobisher wells, the 10 Frobisher wells, were drilled by 5 different operators. So again, we're really seeing, broad activity in Southeast Saskatchewan, targeting very profitable shallow light oil development. And, we do have a very strong production base now in Southeast Saskatchewan, but ultimately there is a lot of running room in Southeast Saskatchewan for us as well. You can see down here at the bottom our recent transactions that we did from November 2022 to December 2023. And 2 of those were Southeast Saskatchewan focused transactions. You can see the November 2022 transaction and the June 2023. So those transactions were deals where there was some initial production on those transactions, where we had a bit of a backstop to our royalty purchase, but we ultimately gave the operator capital to ramp up drilling. And so these 2 transactions were $3.5 million and $3.3 million transactions. We got a 2% royalty in this instance, 10 sections of land in the first transaction and 9 sections of land in the second transaction. And then that operator committed to very robust drilling on those lands. So the first deal had a 15 well drill commitment over 2 years. Those wells were drilled in 11 months. The second transaction had a 12 well drill commitment, and those wells were drilled in 7 months, again, with a 2-year commitment. So you can see the aggressiveness of the operator in drilling out the lands. Of those 27 wells that were drilled, only one of those wells did not become an economic oil producer. So 26 of 27 wells were successful. Again, 19 sections of land there. Those 26 wells are just kind of dipping the toe in on those lands, and there's a lot of now follow-on locations to be drilled on those lands. And we're seeing that operator continue to aggressively drill those lands on their own schedule now that they've satisfied the drill commitment. Similarly, we set up a deal on our first heavy oil transaction in the Clearwater with a similar structure, a bit larger transaction though. So you can see here with our December 2023 transaction, again, this contiguous block of land, largely contiguous block of land up here at Figure Lake. We did this transaction with Rubellite Energy. They had delineated and got on production an initial pool on these lands that was producing approximately 2,800 barrels a day at the time of our transaction. We put a 1.5% royalty on these lands, which was getting us an initial production profile of 40 barrels per day. Now, again, Rubellite has aggressive development plans on these lands. Ultimately, they committed to drill 59 wells on these lands over a 2.5-year period. And so that for us is an important characteristic in the transaction, where not only are we getting exposure to 40 barrels a day of existing production from the 2,800 barrel a day gross production pool, we're getting exposure to 95 sections or 61,000 acres of land, which is 80% undeveloped at the time of our transaction. And Rubellite was very aggressively committing to drill these lands. Now, importantly, if Rubellite doesn't satisfy this very substantial drill commitment, there is a per well penalty that they don't satisfy that we would then get back from them in exchange for them not satisfying this drill commitment. So it is really a kind of best of all worlds scenario for us in the sense that we've got exposure to a large contiguous land block. That land block has a defined pool with strong production on it already, and the operator is aggressively committing to drill the undeveloped lands. And if they don't satisfy that commitment, then we would get a portion of our purchase price back. Now, our expectations on this drill commitment from Rubellite is that they are going to drill a well per month for all of 2024. Again, not necessarily on a calendar month basis, but on average, a well per month, because they are now stepping out from that defined 2,800 barrel a day pool and looking to expand the parameters of that pool on the undeveloped portions of the land. On the back of that delineation process or step out process to expand the pool, we would then expect them to get extremely aggressive with satisfying the drill commitment in 2025 and early 2026. And so they have to date since the deal been doing exactly one well per month, stepping out from the core defined pool. And so they are kind of undertaking what we expected them at this point. And again, as I just mentioned, we would expect that activity level to ramp up in 2025 once they define the parameters of the step out, from stepping out from the pool more. And importantly for them as well, and for us, is that, this is a heavy oil project. We did the transaction to get exposure to heavy oil at a time when Canadian heavy oil prices were improving. But, we're finding that one upside scenario for us in this asset that we didn't contemplate at the time of the deal was that they are now building out gas handling facilities and gas conservation facilities on these lands. And so we will, as they develop this asset, get exposure to the gas as well. But that is not something that we factored into our deal when we did it. It's just more of another upside scenario for us in this transaction, is that as they build out the gas handling and gas conservation, we will get royalty BOEs on the gas as well. So in terms of our acquisition strategy and really the landscape that we see in Canada, we again went public and listed on the venture exchange to ramp up growth because we were seeing more opportunities than the capital was efficiently accessible as a private company. And so, Canada is a bit different in terms of the royalty landscape in the sense that, fee title and mineral interests in Canada are only approximately 10% owned privately. So the government controls 90% of the mineral interests in Canada. Now, that's kind of the inverse to the United States, where I believe approximately 90% of the mineral interests in the United States are owned privately, and approximately 10% are owned by the government. So it does create a bit of a different landscape in terms of pursuing royalty acquisitions and the acquisition of mineral interests, in that, ultimately if we were solely focused on acquiring fee title and mineral interests, it would be a much slower growth profile in the business. So although acquiring fee title and mineral interest is part of our acquisition strategy, it is not necessarily our focus day to day, because again, they're harder to find, harder to acquire. They're quite expensive to acquire typically, fee title, perpetual mineral interests. They have a bit of a family cottage, connotation to them, and that people don't want to get rid of them unless the value being ascribed to them is probably above market. So again, we're always looking for those fee title, mineral interest opportunities. We have some of those in our portfolio, but it isn't something that we're focused on too much day to day, because again, it's a bit of a laborious exercise. We also acquire existing royalties from time to time, and I would say that's been about 20% of our acquisition strategy over time, where we're acquiring an existing royalty interest that is owned by a third party already. We purchase that royalty interest from the third party, and then that operator who is paying royalty revenue to the existing owner then just transitions to paying us. So, the downside to those scenarios is that you're not establishing a direct relationship with the operator through that transaction, and you're not really getting any kind of obvious insight into what's going to happen on those lands going forward. So the royalty lands in that instance need to be extremely prospective. And we need to know that there's going to be ongoing drilling activity on those lands, because we're not getting any kind of commitment from that operator to undertake ongoing development. So really our focus, as you can see through our 4 transactions here since we went public, is that, you know, we've been working with the oil and gas exploration and production companies in Canada, primarily junior companies that are, you know, sub 400 million market cap companies, 2,000 to 3,000 barrel a day type producers. And we're effectively giving them royalty capital, purchasing a royalty that's carved out of their working interest, and becoming their partner in the development of that asset. Now, royalty capital here, I've got this capital stack flipped upside down, because ultimately the capital stack for these junior oil and gas producers in Canada has really been flipped upside down over the last 5 years, where, you know, debt is really largely unavailable to the junior industry at this point. And if it is available, it's typically on such onerous terms that the operators don't actually want to take on that debt. So debt was historically, you know, kind of the first stop source of capital for these producers. They would typically be able to borrow on a reserve-based lending structure quite easily. And that has become a very challenged source of capital for them. Again, it's either too costly, it's largely unavailable, or they just really don't want to, you know, risk their company going forward, because ultimately these lenders have shown that on the junior company side of the industry, as soon as times get tough, the lenders are not necessarily there to be their friend anymore, and they call back those loans quite quickly. So, you know, equity at the same time has become a challenged aspect or source of capital for the industry as well, because equity has become, you know, very, very undervalued, in the sense that cost of capital and equity valuations are low. So equity valuations low makes cost of capital from equity high. And those equity valuations have now stayed at historically low levels for an extended period of time. And so for a junior oil and gas company to complete an equity financing, it would be extremely dilutive. And I would argue that most junior oil and gas companies can't even access equity currently. It's just largely unavailable. You know, most of the equity that's flowing into the oil and gas industry is doing so at the higher ends of the market, pursuing, you know, ownership in multi-billion-dollar companies. And, you know, in these very, very well positioned, very well run junior companies that are, you know, again, kind of 2,000 to 5,000 barrel a day companies, they're being valued so low that they just can't access equity to grow their business. So royalty capital has really moved to the top of the capital stack. And again, you know, we're buying a piece of an asset in the form of a royalty and becoming that operator's partner. It's a very passive, friendly form of capital. The industry has really kind of come to realize that it's a source of capital that is needed in the capital stack in the industry currently. So we're getting a lot of traction with smaller companies positioning royalty capital, getting mutually beneficial deals done. And at the same time, you know, we're even seeing much larger companies use royalty capital in their capital stack. Companies such as Whitecap, Tamarack Valley, they're kind of actively over the last 3 years been using royalty capital to again either subsidize and help fund an acquisition or to just ramp up development on their asset. And so, you know, I think the important thing to just highlight for us is that these royalty partnership deals do really create the right balance for us in terms of what we're looking for in our assets. You know, we're getting exposure to existing production, so proved developed reserves. We're getting exposure to undeveloped land that has identifiable drill locations on those lands. And importantly, we're getting drill commitment from these operators to aggressively drill those lands near term and create growth on those lands for our royalty interests. So then in terms of summarizing all of that, so, you know, again, we're sitting here in the public markets as the only junior oil and gas royalty company listed in Canada. We have the highest yield amongst the royalty peer group in Canada. We are providing that yield on a payout ratio that is very in line with our larger peers and at times below the payout ratios of our larger peers. We're driving a netback, or again, profit per barrel that is, you know, top tier from our perspective. You know, again, higher than what we can find in the marketplace because of that oil focus and because of you know, the low cost structure in which we run the business. You know, we're trading at a valuation that is substantially low our much larger peers. You know, again, we're trading at, you know, 5.5, 6 times cash flow. Our peer group trades at, you know, 9, 11, and about 16 times cash flow. And so again, very a material disconnect there from a valuation standpoint. And, I think importantly, the valuation side, we're seeing private royalty sale transactions happening that are private equity backed, that are happening at multiples substantially higher than our trading multiple as a public company. So again, we feel like there's a strong disconnect there in terms of the valuation being placed on our business, given our high yield, given our track record of paying that yield alongside growing the business, and given our execution on continuously driving a strong net back. And again, we're positioned for growth still. So we've executed on material growth. As I mentioned, 40% production growth since we went public, 100% growth in our lands. But with our existing cash balance of $3 million still, we're positioned to continue to compound growth for existing shareholders through recycling that cash and our free cash flow going forward into new royalty acquisitions. We're setting up for, again, a very strong 2024. Our Q1 2024 royalty revenue annualized would be about 6.9 million revenue on an annualized basis. That would be a very, very significant revenue number for us. And again, we would be driving as much free cash flow to the bottom line as possible because we're able to, again, grow within our existing cost structure. And that will be our focus going forward, is that our acquisition strategy will stay simple in the sense that we do not want to have to, grind cash flow. We don't want to grind the revenue as we grow. We want to make sure that all of the revenue is driving to the bottom line, staying oil focused so that we can continue to have an industry leading netback, and at the same time provide this strong yield that we provided for an extended period of time to make sure that shareholders are rewarded through that dividend. And I think lastly, importantly, I'd just like to point out again, our lead institutional shareholder, 21% shareholder, they have not sold a share since we went public. They continue to be a very supportive shareholder for the long-term growth of this business. And again, they are kind of on side with our strategy of continuing to build out an oil-focused portfolio and focus on these niche opportunities that we see through our relationship group in the industry.
All right,
I will pause there and open it up for questions.
Okay, good job, Brad. I just want to remind our members that, I've been doing this for a long time, and my biggest gains have come on finding companies that are off the radar screen. They're too small for a lot of the analysts to cover, but I look at them and they have strong teams, they have strong balance sheets, they have a low risk business strategy like this, and they have and number one for me is visible production growth. I can see that they've got the cash flow and whatever to continue to grow production quarter after quarter, year after year, and especially for dividend payers, it's sustainability of the dividend that is key for attracting investors into the strategy. And I mean, you hit it on the head, Brad, that the equity market and the debt market is pretty much cut off for the smaller companies. So this is just a way for them to raise capital. But again, this is a much different, and we have 4 royalty companies in our high yield income portfolio, but they're really out contacting actual mineral owners, the owners of the underground minerals, and buying true royalty interests, where these are overriding royalties carved out of a working interest. So the relationship and the, quote, contract or deal structure with the operating company is just key to the success. So let me go through a few questions that I had before we even started, and then which I think you covered a lot of them. So Brad, what is the current production now, and is it still 95% oil?
Yes. So yeah, Q1 production was 241 BOEs per day, and it was 95% oil. Yes, that would be the most current production number that we have in the market.
Okay. Okay. You named several of the companies that you have, but you have good working relationships with them, and they keep you, or you're keeping informed with their drilling programs and everything, and all those are public companies, so it's easier for you to do it, right?
Yeah, absolutely. So the relationship with the operators varies a bit depending on whether we created that royalty with them and established call it a partnership, working relationship through the creation of that royalty, or whether we acquired a royalty that they were the operator of. And so, ultimately our partners that we've done the royalty transactions with directly, where we're creating a royalty in their interests, those are certainly very strong relationships where we're actively talking to them to know what's going on, what's gone on, getting as up-to-date information as possible on a kind of a week-to-week, month-to-month basis. So we know not only what's happened very recently, but in terms of drilling activities, but also what's gonna be happening both near term, medium term, and long term, and obviously those strategies evolve, right? As wells
Hmm.
are drilled, things can change, and so they are very good at keeping us up to date. And again, that would be very different than, take for example, let's say Whitecap. Well, if we own royalties in Whitecap's lands, they're not going to be actively giving us insights on what their drilling plans are because we haven't established that royalty with Whitecap per se. They are just the current operator of those royalty lands. And
Hmm.
so, I think for us, back to the strategy of these partnerships, we are focused on, the smaller companies. And again, some of these companies aren't actually that small these days. I mean, companies that are producing 2,000 barrels a day of oil, that's actually a pretty sizable, revenue generating company. But we'll call them smaller companies. And so those companies that we're partnered with, ultimately a lot of those companies aren't forever the operator of those lands. And so, we have never done a transaction directly with Whitecap as the example, but Whitecap is currently our second largest payor. And so why that happens is that we do these transactions with the smaller companies that are, the 1 to 2,000 barrel a day producers. They develop the assets to a certain level, and then they look to sell themselves. And so then
Hmm.
those assets will transfer from the smaller junior company over to a larger company like Whitecap, and then Whitecap will undertake more of the kind of middle to back end development of the asset and really kind of create that longer term development plan. And so, we have seen that again happen with Whitecap in particular, where they acquired 3 junior companies that we had royalty interest with, and then after they acquired those 3 junior companies, they then became one of our sizable payors.
Hmm. Now, your actual royalty checks are paid directly from the operating company or from the first purchaser?
They are paid from the operating company
Oh,
as, yeah.
directly from the operating company. So, I mean, I guess you could say you got a little bit of risk there if they would get into financial trouble or something. But in Canada, are royalty payments, they're considered above normal debt, right?
Yeah, so our royalty interests are attached to the lands, and so
Right.
they as the lands change hands over time, whether that's a good reason because a company sells themselves or a bad reason in the sense that a company gets themselves in trouble. Again, our royalty interest attaches to those lands and flows
Okay.
with those lands. So whereas balance sheet is on debt, or sorry, debt is on balance sheet, and so again, our royalty interest will just go flow with the lands. And we going back to COVID times, we did have one very small operator. I believe they're paying us $5,000 a month of royalty revenue, and they went into receivership. And our royalty lands obviously were part of that. And the royalty lands went through the receivership process, came out the other side, and on the other side of that process, 7 different operators operated the lands instead of the one small company that we had done the transaction with. So again, the it's not balance sheet related. Our royalties travel with the lands, and again
Yep.
through even the really bad scenarios that you can think of. Again, the as long as the lands transfer on to somebody else, then our royalty will transfer with those lands onto another operator.
So it would only go away if their working interest went away. Like they quit drilling and the lease is expired.
Exactly. Yeah. So
Then it
the,
would go
the
away.
the
Okay.
royalties are valid for the life of the lease, and the lease would be valid for the productive life of the lands.
Yeah. So as long as they're productive, they keep going.
Correct.
The question I had is why are operators willing to carve this out? But it does make sense. Let's say one of those smaller companies you mentioned, they come up a little short on CapEx, on money to complete their CapEx program. But you look at, we follow some companies down in the Frobisher there in southeast Saskatchewan, and man, those Frobisher wells are paying out in 8 to 10 months. At $70 or $80 oil, they're paying out 8 to 10 months. You
Yeah.
got in play in there where their oil in Pembina is paying out in 8, 10 months too. So they can recoup this pretty quickly if they, carve out a really 1.5%, 2% royalty. They can, if they can complete those wells quickly, they recoup that very quickly. So it makes sense. And like you said, it doesn't show up on their balance sheet as true debt. It's not.
Correct.
It's not. It doesn't mess with their balance sheet, but they get the cash, so that helps their balance sheet ratios. So it makes a lot of sense. I mean, I can see. What are you seeing up there? We've heard about the differentials coming down because of this Trans Mountain pipeline. Are you seeing that in oil prices up there?
Yeah, absolutely. Let me just touch on your last point just to round that one out. So before I talk differentials,
Okay.
so I think why are companies doing this? I think again it is multifaceted, right? In the sense that companies, most of the companies we're dealing with, they're extremely well positioned, but
Hmm.
they have more that they want to do than their cash flow can allow them to do. And so not only do they want to drill more wells faster because, like you said, they're paying back very, very handsomely at current oil prices.
Hmm.
They also want to continue to acquire more lands in their core areas and build out their land position. They may want to acquire a new producing asset, and they can't acquire that with just cash flow or their balance sheet. And again, debt and equity are arguably not available. So, again, it's multifaceted in the sense that it's to help fund acquisitions of producing assets. It's to help fund new land purchases in core areas where operators are having success. And it's also to help fund the ramp up of drilling, again, of these very lucrative projects that are, again, oil
Yeah.
focused, low, relatively low cost. These aren't, Duvernay Montney wells that are getting drilled for massive capex amounts. These are $1 to $2 million shallow oil projects where, again, returns are happening, 8 to 10 months for sure. I mean, we're seeing some that are 2 to 5 months,
I know. It's
depending on
amazing.
depending on the drill results. So, so for them to be able to do more quicker, at the same time establish a financial partner, in the sense that, again, they're selling us a piece of that asset in the form of a royalty, and we become just as vested as they do to see the long-term successful development of that asset. And so,
Hmm.
they're getting a true partner, as opposed to a debt provider who's not really your partner, in the sense that they're, as soon as times get tough, they're no
They're not your
longer
partner
your friend.
anymore.
Yeah. So yeah, so we are really finding that the desire to do these deals is for lots of different reasons, and all of them good, in the sense that there's just lots to do, and cash flow can only be recycled so quickly, and you can't do everything you want with just cash flow.
Yeah.
And so we would never be looking to do a transaction with an operator that's stuck. These are operators that are well positioned, looking to do more.
Hmm.
And so we wouldn't be a capital solution to an operator. We're just, again, part of their capital stack and part of their ability to fund, growth.
Yeah. I mean, I
So
like the strategy. So what about the Trans Mountain Pipeline? Have
yeah,
you seen an impact?
yeah, great question. So as I mentioned, we did our first heavy oil transaction in December of 2023, which was the Clearwater transaction. Prior to that, we had no heavy oil exposure. And so, we strategically did that deal at that time because we thought that it was the right time to get some heavy oil exposure. Differentials were $19-20 at that point in time when we did that transaction. And we've seen those differentials come down to $11 to $12 in the last few weeks. So that, again, is part of the strategy was get some heavy oil exposure, get some Clearwater exposure, because it's obviously a very lucrative play, just like the Frobisher. Strong operator that has very good capital markets, relationships that can build out the asset over the long term. But again, gave us some exposure to this differential tightening that we expected, and we've
Hmm.
certainly seen it. So, ultimately, longer term, obviously anybody's guess is valid, in the sense of does the industry backfill the TMX capacity, and we're back in the same position 5 years from now. Who knows? Point in time today, the differentials definitely squeeze down here to levels that are more attractive, and for us as a purchaser of a heavy oil project, at a $19-20 differential assumption, seeing $11 to $12 differentials, is just added value for us in that transaction.
Yeah. Yeah. Well, I follow, I have several of these Canadian juniors, and they're all pretty excited about the higher realized oil prices they're going to get in the second quarter. I think people are going to be surprised by the second quarter results. Um,
Yeah, and I think just important to point out for our portfolio as well of royalties is that heavy oil is still a smaller component of our portfolio.
mhm,
Call it kind of 20%. Our light oil portfolio doesn't have the same exposure to differentials that heavy oil does. So our light oil would be sold off of Edmonton par pricing, or there's a different price point even for Southeast Saskatchewan. All of the oil in Southeast Saskatchewan flows down to Cromer, Manitoba, and so those pricing differentials are very different than the WCS heavy oil price differential as well. And so when I'm talking $11, $12 differentials, that's a heavy oil differential a WCS differential to WTI. Again, our light oil differential would typically be in the $3 to $4 range from WTI.
Yeah, I mean, you don't sell much gas, but I'm getting the feeling that the long-term potential price increases for U.S. natural gas and NGLs is going to be very bullish here after we get past this year. So anyway,
yeah, we've definitely not been gas focused. Again, trying to drive that net back with the oil focus. Trying to differentiate ourselves a little bit. And so ultimately our three larger peers are all more gas focused. And so we've tried to be the pure play junior oil royalty
okay.
company. And so we have I'll call it inherited some gas over time as it's a byproduct to oil in some instances. We envision, as I mentioned, that we will get some exposure to gas as the Clearwater play is built out, and there is some byproduct gas coming out of that play. We would not likely go out and do a gas focused transaction. We will look to maintain our focus on oil. Again, if gas comes up through those opportunities, then that is fine. But we will be looking to again diversify our portfolio of royalties across different regions and different operators, but ultimately maintaining an oil focus primarily, again, to differentiate ourselves, but also to leverage our relationships as much as possible. And our relationships as a group are more in the oilier parts of the basin.
Okay, yeah. Do you hedge any of your production?
We do not.
Do not. Okay. There's a question here from Cliff. He says it trades in the USA as SRRRF. So that's the pink sheet symbol.
Correct.
Okay. If somebody buys it down here on the pink sheet, they still get the dividends every month, right?
Correct.
Correct. Okay. Yeah. And the differential in price, if you just multiply the Canadian price by 0.74, you should come pretty close to what the US stock price is. Okay.
I would, and on that, I mean, I would encourage people to try to purchase it on the venture exchange. We do have several U.S. retail shareholders that have, been able to access it through the venture exchange. We are a tier 1 venture exchange issuer. So, in terms of if people are talking to their brokerage firms, there are different tiers to being listed on the venture exchange, and so we are the highest tier on the venture, and so that may help if a back office is saying, well, this doesn't qualify. Ultimately, again, that's just kind of one other piece of information to point out, is that this is a tier 1 venture issuer, and again, we do know it's accessible. There are certain Canadian brokerage firms that have cross-border abilities to allow purchases. So again, certainly encourage people to try to buy it on the venture. Medium to long term, we may look at upgrading to an OTC listing. We just have not done that to date because we haven't really undertaken any marketing in the US. And so ultimately our marketing efforts have been focused on Canada. And so that's obviously where the most of our retail buying is coming from, with the exception of a couple of large US retail shareholders that we do have.
Yeah, and for the listeners here, it's easy to set up a platform where you can trade on the Canadian market. I mean, I trade through E-Trade, and I think it took me all of 20 minutes to set up the ability to do that, so it's no big deal. And yeah, if you are buying these pink sheet stocks, just look at what the trading volume is, because sometimes there's like no trading at all on a certain day. So if you do need to sell it quickly, it might be hard to do. So anyway. Okay, what's pink sheet? Okay. Oh, how are your dividends taxed for U.S. investors? I think it can be held in IRA accounts. I think they're just taxable income. I get dividends from In-Play and Hemisphere, and I think they just show up as, and they do withhold a Canadian tax. I think they withhold 15%, but you get that back as a foreign tax credit on your tax return. You agree with that, Brad?
Yeah, that's my understanding as well, for sure. Yeah. So yeah, again, it's just a standard dividend. There's no kind of special aspects to it or anything. So it's a standard corporate dividend. Obviously not positioned to speak too in depthly on US tax laws, but ultimately my understanding is that yeah, the 15% withholding tax happens, and then you can claw that back, and it should be eligible to hold in registered accounts.
Yeah. let's see, there's some special dividend. Yeah, let me just read this. Dividends Article 10. For Canadian source dividends received by U.S. residents, the Canadian income tax generally may not be more than 15%. And I've owned Canadian stocks for a long time, pay dividends. I've never seen them withhold more than 15%, and I get it all back or most of it back as a foreign tax credit. So a 5% rate applies to intercorporate dividends paid from a subsidiary to a parent corporation. Well, I don't care about that. And these rates do not apply for the owner of the dividends carried are a business. If you carry on a business in Canada through permanent establishment and holding on to which income. Okay. So, I mean, just, if you're going to invest them as an individual, fine. I don't see any problem with owning them. I've owned a bunch of them in IRA accounts. And I think in the IRA accounts, they don't withhold the 15%. I think you get those tax-free, but I'm not 100% sure on that. Let me ask you this. What if some deal comes to you, an opportunity that's more than what your working capital is? Do you have access to other capital? I mean, could you go get a credit line or something in case a really good deal comes your way?
Yeah, so we'd be unlikely to access credit more because of our choice to not want to pursue accessing debt. So I think our more likely approach would be that we again believe we're undervalued. We have grown, as I mentioned, production by more than 40%, lands by 100%, and our share price is at the same price as when we went public
I know,
2 years
it's
ago.
amazing.
And we've increased the dividend by 30%. So we believe we're undervalued. Ultimately we have been working hard on trying to reestablish a better valuation on the business. But at the same time, we want to grow the business, and there's lots of opportunities in front of us. Ultimately for us, we would not undertake an equity financing unless it's A, at a higher price than today, or B, we are doing so to complete a very accretive transaction. And so, if we had our hands wrapped around a very accretive transaction at the current share price, well, then that's in the best interest of all shareholders to complete a very accretive transaction. And that would need to be accretive not only from an existing production and revenue standpoint, but also from a longer term undeveloped land growth exposure standpoint. And so, we're certainly very cognizant of, we don't want to get in the cycle of issuing stock, completing transactions, issuing more stock at the same price. Because again, we're all just as vested. We're big shareholders ourselves with the same cost base, and so we'd be diluting ourselves as well. But ultimately, at some point, maybe the right transaction comes along where it's so attractive, so accretive, that we say to ourselves, ultimately, it makes sense for everybody, and it's in the best interest of everybody to finance the business where the market is valuing it in order to create this per share growth through completing this new transaction. But that certainly isn't our current goal or plan. I mean, our current goal is to, use our existing cash and free cash flow to compound growth for shareholders, and continue to work on creating, a higher valuation on the existing business.
Yeah, and another thing, I mean, your assets are very liquid. I mean, if you had to sell some assets to raise money for a bigger deal or a more creative deal, you could do it, right? I mean, royalties are very sellable, let's say.
Yeah, I mean, we've never sold an asset, so that would be certainly something new, and we've always been an acquirer of new assets. So not something that we would expect to pursue. But I think ultimately we would be always looking to accretively grow the business for shareholders is our focus. And so, if we can't do that through our existing cash balance and our free cash flow, and we need to look at alternative ways of funding a very high quality accretive transaction, then that would likely be looking at trying to strategically position equity in some way. Again, though, our goal is to be looking at higher valuations than today, given the growth we've achieved since our public listing.
Yeah. Okay. Do you have any major milestones coming up this year that you are on your radar screen?
Yeah, I mean, we just obviously announced record production last week, so that was the first full quarter of all of our acquisitions in 2023 being presented in one quarter. So that to us was a material report in the sense that we completed the series of acquisitions that the market was somewhat waiting for us to do, in the sense of, well, what are you going to do with all your cash? We've now completed that series of transactions. We've hit record production in Q1 on the back of those transactions. And now we obviously hope that with existing oil prices, we continue to see robust growth. And not only are we, looking to execute on growing our portfolio through more acquisitions, but ultimately we want to see and show the market that the growth is there within the existing portfolio as well. So, in terms of, I think, milestones, that would really just be, proving to the market that, we can continue to grow this business and continue to create, a broader, more diversified portfolio that is again, oil focused, without having to dilute the interests of existing shareholders. And, I think that Q1 report does really highlight that, in the sense that, that was from the day we went public to that Q1 report, that is 50% production growth and 100% growth in our lands without issuing any new equity since our go public transaction, and we grew the dividend by 30%. And so, I think that is a really, to me, that report was that, and those financials were extremely important to show the market that, we're capable of doing what we said we were going to do. And, now I think our goal is to just continue to do what, we were telling the market we say we can do, which is compound growth, and not dilute the interests of existing shareholders by doing something that, again, it isn't accretive, or, doesn't just grow through our existing balance sheet.
Yeah, it's just the oil price volatility that's keeping investors away from this area. There's nothing else to, in my opinion, to explain the low valuations on some of these very profitable junior Canadian companies. I mean, it's just amazing. Ed did ask one question about how does the foreign tax credit, how does it work in an IRA? All I can tell you is my wife owns a lot of hemisphere in her IRA, okay? And they don't withhold the tax on it. So it's not a problem there. But I don't know if you buy that on the venture exchange, I don't know how that works. So you need to do a little bit of work on that your own. So I wouldn't, yeah, anyway. All right, Brad, hey, that was great, man. You guys are definitely on our radar screen, that's for sure. And it's on my watch list now, so I'll keep watching it. We'll probably do a profile on the company here next month, maybe, and just go from there. Thanks again for agreeing to host this. And it will be, we'll send out the link, so all of our members will get the link this afternoon, and then on YouTube it will go live to anybody in a couple weeks, and that's when it'll probably get a lot more exposure for the company. All right, buddy. Hey, thanks a lot, and we'll keep in touch. All right.
Yeah, thanks so much for having me. And certainly anyone that's listening, certainly follow up directly with questions. If you want to send me an email, I'm always happy to take inbound. So don't hesitate.
All right. Thanks a lot.